Zoom just posted a jaw-dropping $1.5 billion in net income for the quarter, but almost none of it actually came from software. Welcome to Earnings Unscripted. It's August 25th, 2026, and we're unpacking Zoom's second quarter, ticker ZM. The top line held up fine. Total revenue was about $1.28 billion, growing just slightly quarter over quarter. But Miro, that bottom line profit number is completely distorted, isn't it?
Yeah, it's a total mirage. You glance at their GAAP net income, and it's up over 260% sequentially. But that's almost entirely driven by a massive one-time gain on their strategic investments.
Right, because the market clearly didn't buy the headline. The stock drifted down all day and then fell off a cliff after hours, ending down about 8.5%. And since we're casually dissecting a nasty stock drop, I should quickly mention that everything we say here is just personal opinion, not financial advice.
Naturally. And look, once you strip out that giant investment gain, their actual operational profitability was perfectly normal, comfortably above the street, but not a rocket ship.
Okay, wait, back up. If that massive profit spike wasn't operational, what's actually happening inside the core business segments?
Well, it's a split reality right now. Their enterprise business actually just hit its strongest growth rate in 3 years. They're signing these big multi-product deals, ripping out legacy tech and installing Zoom Contact Center.
But let me guess, the self-serve online stuff is dragging them down.
Yeah, the online segment is hitting a wall. Top-of-funnel discovery is getting really tough, so management basically downgraded that segment's full-year outlook to flat. So they really need everyone to see them as an AI powerhouse right now, not just a meeting link.
They didn't do another clunky AI demo on the call, did they?
Even better, the CEO and the CFO read their earnings scripts using hyper-realistic AI avatars of themselves.
You're kidding.
No. The CFO admitted on the call it only took her minutes to clone herself. It's bizarre. But honestly, it proves the point they're trying to make about their new workflows.
That's wild. But honestly, I'm way more hung up on a totally different kind of engineering happening under the hood. I saw this note about how they suddenly changed the accounting lifespan for their data center servers, and I need to know what that's all about.
Yeah, so this is one of those subtle moves that does a lot of heavy lifting. Management decided to just extend the useful life of the assets in one of their data centers by 2 years.
Okay, wait. Walk me through that. They just decree that their servers live longer and suddenly they make more money? I mean, I know how depreciation works, but depreciation isn't a cash expense. How does an accounting shift actually put more free cash flow in their pocket?
It doesn't create cash today, but because they're officially stretching the lifespan, they don't have to buy replacement hardware as soon. That mechanically lowers their capital expenditure guidance for the year. The CFO literally said, and I quote, "Look, we took a decision that benefited our free cash flow raised by about $40 million to simply extend in one of our data centers the useful life of the asset by 2 years."
That's, wow, a very politely phrased lifeline. Like, we just decided to spend less so the guidance looks better.
Spot on. It artificially props up that cash metric right when they're ramping up heavy AI investments, because their actual reported free cash flow dropped roughly 6% sequentially to around $472 million. They really want to keep the headline numbers looking robust.
Especially since they're suddenly stepping out of their comfort zone with acquisitions, right? They finalized that deal for Common Room in July.
Yeah. $250 million. It's their largest acquisition to date, which is kind of shocking for them.
Oh, absolutely. They usually guard their operating margins so aggressively. Buying an early-stage pre-profitability startup feels like they're finally willing to, dilute immediate margins to pivot hard into sales tech.
Well, they have to. They're trying to build out the Zoom Revenue Accelerator ecosystem. The CFO noted they're moving into a different layer of value by helping customers drive their own revenue. You don't make a chunky acquisition like that unless your organic bottom-up discovery is stalling out.
Which brings us right back to that online segment hitting a wall we mentioned earlier. If people aren't just organically finding the product anymore, you have to acquire tools to help you go hunt for them.
Or you change how you charge for the product entirely. This was actually the most interesting part of the transcript for me. They're testing outcome-based and consumption-based pricing for their AI tools.
Oh, interesting. So instead of a flat per user fee every month, you only pay if the AI actually resolves the ticket?
Basically, yeah. The old predictable subscription model is cracking, specifically for things like Zoom Virtual Agent. Charging a standard $15 a seat doesn't work for generative AI. You have to tie it to resolution metrics or tokens used, which completely resets SaaS economics.
Right, because a bot isn't a seat. A bot is doing the work of 5 seats.
Exactly. The CFO actually framed it as, well, she said, the market at large is shifting to more consumptive. We also employ full consumptive, outcome-based, and a combination of per user with a certain amount of consumptive.
But if everyone shifts away from paying per seat, how do you even forecast revenue in an outcome-based world?
It becomes incredibly difficult. You're suddenly predicting success rates, not just headcount. It shifts from predictable recurring revenue to something much closer to utility billing. If the AI fails to resolve a customer issue, you just don't get paid.
That sounds like an absolute nightmare for analysts trying to build their models. You're basically taking on the execution risk for your clients.
Precisely. That lack of predictability is probably why they're leaning so heavily on their traditional enterprise segment right now. They actually raised full-year revenue expectations to somewhere between $5.08 and $5.09 billion.
Right, and they noted that specific raise assumes enterprise keeps outperforming just to offset that flat online growth you brought up earlier.
Which makes sense, because they're definitely running into friction with some legacy deals. Management actually blamed an undisclosed white label partner churning out for dragging down enterprise growth by roughly 40 to 60 basis points.
Wow. Okay, so a legacy partner quietly bleeding out in the background. But looking at this entire mosaic, the common room buyout, the avatars, the server accounting tweak, does this feel like a company transitioning gracefully, or are they just scrambling?
I think they're surviving a very tricky phase. You've got to give them credit where it's due. Their core enterprise retention is still holding steady at 99%. They even highlighted a massive renewal with a large U.S. tech company simply because Zoom integrates smoothly alongside Google Workspace.
We use you because you play nice with our other stuff. That's not a terribly sexy narrative, but it's incredibly sticky.
Sticky pays the bills. They're trying to build a unified communications empire, and if this aggressive push into AI works, they might actually pull off the pivot.
Well, I guess we'll see if the avatars can start answering the tough analyst questions live by next quarter. All right, that wraps up our look at Zoom's bizarre but fascinating transition. Thanks for hanging out with us, everyone.
Catch you next time.
If you're finding these breakdowns helpful, it's not a bad idea to make us a regular habit when earnings season rolls around. And since we were just talking about Zoom's digital avatars, it's highly appropriate to mention that this entire podcast, Our Voices Included, is a fully synthetic AI experiment, turning today's call into this episode on the exact same day. If you've got feedback or a ticker you want us to dissect next, send a note to earningsunscripted@datamadness.ca.
We'll see you next time.